Let's bring in Michael Gapen with news on the first quarter GDP estimated. And frankly, news. Oh, the ink smells on this. It's so fresh. Nice of you to bring along a revision. Why did Barclays Capital consider the optimist by many on the street? Why did you go from 3.5 to 2.0%?
I think there are two main reasons. The first is that we had a strong acceleration in inflation in the first quarter. So a quarter-on-quarter annualized CPI growth came in at about 5.1%. That was twice that we saw, twice the level that we observed in the fourth quarter. So while nominal spending by consumers held steady, what that led to was a decline in real spending. So that was the first component. The second component, we think, is there were some weather-related issues and its impact on construction. We think there will be some give back of that going forward.
Does seasonal adjustment, does that factor in weather?
It does, but it looks at more of a normal historical weather pattern or an adjustment for activity that would take place during a normal winter. And obviously we had several much stronger storms that blanketed larger portions of the country than would be normal. Yeah. So the seasonal adjustment wouldn't necessarily take into account all of that.
So you guys become weathermen. Is there such a thing as a Keynesian weatherman? It's like a dartboard, frankly. But you go up for this quarter. Is that just borrowing from that first quarter and pulling it forward?
To some extent, yes. So we came from 3.5 down to 2 in this quarter when we went from 3 up to 3.5 next quarter. So a little give back, but on average a weaker profile.
Inside baseball, dreaded first chart. This is from yesterday. I didn't get to it. Stuff-free import is more expensive. Ex-oil, ex-petroleum. You can see the surge there in 08. Down we go with crisis and up. And look at that little, that's like a Victoriaville 5 lie, I would say, that little curve up there. Why should we care about import price inflation?
Well, what we care about here is that producer prices are rising, whether they're import prices from abroad, whether they're higher energy prices. These are the inputs to the final production process. So to the extent that firms eventually will be able to pass these price increases along to consumers, we call this building pipeline pressures. There's an issue on how much firms can actually do this. We think that there's more firming in the inflation process than many think.
You are right on script, but we don't have a script here. We don't plan. Here it is, folks. Charles Dumas today. Talk about too much information. Is Michael was just talking about pipeline pressures. They're already there in Germany. This is German PPI. Charles Dumas saying Berlin chooses inflation, and this is the political economics of Europe, very different than here. I haven't talked about PPI inflation, business inflation, it seems, in 5 years. This is something for next year, isn't it?
That's right. So to some extent, this is how able firms are to pass along these prices, and some extent, is based on your view of how much slack is out there. So to the extent that, yes, there's a high level of economic slack now, which may make it difficult to pass these prices along this year. Next year, we expect there to be less, so there's more ability of firms to pass along those price increases.
I mean, within the economy now, and it's sort of been a goofy week, is how I'd put it here. We're sort of mixing it around. Now, what's the greatest uncertainty you have when you look at C plus I plus G plus net exports? Where's the mystery for Barclays Capital?
Well, I think the mix right now is still one of, there are risks out there, whether it's related to Japan or some of the other issues. So we present those as, yes, there are risks to the forecast. And I think you are seeing a conflicted message from GDP statistics right now. The goods production is much stronger, whether it's manufacturing relative to services. So the GDP numbers quarter to quarter are masking some of the underlying strength in the economy.
Here's today's retail sales report. Let's look at it with Michael Gapen here. The consumer surprises the economist. I don't mean Barclays Capital yourself, but there we are. There's a recovery. Barclays Capital predicted this. There would be a resilient consumer. I was surprised. And with the revisions today, I'm sorry, it's a good consumer, isn't it?
Well, yeah, so we think on a quarter-to-quarter basis, you are likely to see some of this up and down. We did see the acceleration in inflation in the first quarter. We think that will moderate into the second quarter. So we think there can be an additional pickup in real consumer spending in the second quarter. So if you smooth through some of this quarter-to-quarter volatility, the strength in consumer spending will continue to show through.
Where's nominal GDP? I mean, with your buoyant second quarter, do we get a 5% nominal in the second quarter?
It's possible. On a year-on-year basis, our forecast in real terms is about 2.9. Our headline CPI by the fourth quarter should be somewhere around 2.8. So on a year-on-year basis, it's possible to get those types of numbers.
Let's look at this chart coming out here. This is just great. Happy Tax Day, America. It's tax day. What do you want to hear from the president this afternoon? I'm going to ask everybody today that question. What do you want to hear from the president on the deficit?
Well, I think our view and the view of most economists is that while the U.S. fiscal situation is not a problem now for markets, it eventually will be. So the issue is how quickly will that be a problem? And what we, and I think what the market wants to hear, is what plan is out there to credibly reduce the deficit and the level of debt at the federal level.
Michael, wonderful update. Thank you. With that news, Barclays Capital brings down their optimism on first quarter to exactly 2%.